Welcome to this explainer. Have you ever actually stopped to wonder how banks survive when they lend out millions or even billions of dollars, facing the constant risk of borrowers simply not paying them back? It sounds like a massive gamble, doesn't it? But it's actually grounded in some fascinating, highly calculated math. Today, our goal is to demystify exactly how banks survive and even thrive in the face of all this uncertainty. We're going to break down credit risk modeling in plain English so you can see exactly how the financial world turns risk into measurable numbers.
Okay, let's dive right in. We're going to break this down into 5 quick parts: the weather forecast of finance, the 3 building blocks, calculating expected loss, expected versus unexpected loss, and finally, why do banks care?
All right, part 1, the weather forecast of finance, a proactive approach to banking.
So here's the fundamental question, right? How do banks survive when borrowers just don't pay them back? It's really important to realize that defaults aren't just some weird anomaly or a massive mistake. They're actually a completely normal, built-in part of the banking business. Look, when you lend money to thousands of people or businesses, some are inevitably going to face hardship. The secret to a bank's survival isn't just crossing their fingers and hoping defaults never happen. It's accurately predicting them and pricing for them well in advance.
The recent history of the banking industry brilliantly illustrates this shift. Before the 2008 financial crash, banks used the old incurred loss model. It was literally like waiting for the rain to start pouring before you even think about buying an umbrella. They would only recognize a loss on their books after a default actually happened. It was too little, too late, right? Well, the crash forced a massive change, bringing in a new global standard called the expected credit loss model. Now, it's like checking the weather forecast and bringing your umbrella just in case there's a chance of rain. It's a totally proactive approach to preparing for financial storms.
So how exactly do they track this financial weather? Well, under the new model, loans basically move through 3 stages. Stage 1 is kind of the honeymoon phase. The loan is brand new, performing perfectly, and the bank just prepares for possible losses over the next 12 months. But say the borrower loses their job or a business's sector takes a sudden hit. Boom, the loan moves to stage 2, warning signs. The risk is up, so the bank has to calculate expected losses over the entire remaining lifetime of the loan, increasing their safety provisions. Finally, stage 3. Houston, we have a problem. The borrower has flat out defaulted, and the bank calculates the loss based on its amortized cost, which is basically finance speak for recognizing the full real-world financial hit.
Moving on to part 2, the 3 building blocks. Let's demystify some of this alphabet soup. First up, we have PD, or probability of default. In plain English, this is simply the likelihood that a borrower will fail to repay the loan over a given time frame, which is typically 1 year. Banks estimate this by crunching mountains of historical data. If they observe that out of 100 borrowers with a specific credit rating, 4 of them default in a year, well, the PD is 4%. It's a super straightforward measure of the chance of things going wrong. Next, we've got LGD, loss given default. If PD is the likelihood of a crash, LGD is the severity of that crash. It's the exact percentage of the money you expect to actually lose if a default happens. And remember, banks rarely lose absolutely everything because they can usually seize and sell collateral like a house or business equipment. So if a bank recovers 40% of the loan value by selling off that collateral, the LGD is simply 1 minus that recovery rate, making your LGD 60%. The third and final block is EAD, exposure at default. This one is all about timing and usage. It's the total amount of money actually at risk at the exact moment the borrower stops paying. For a standard term loan, yeah, it's pretty much just today's outstanding balance. But for revolving products like credit cards, oh, it's way trickier. A desperate borrower in financial trouble is probably going to max out their unused credit limit right before they default. So EAD actually has to include those potential future funds a desperate borrower might draw down.
Part 2, calculating expected loss. Let's look at the grand formula.
Let's see how this all builds together into one magic equation. Expected loss equals PD multiplied by LGD multiplied by EAD. Literally, when you multiply the likelihood, the severity, and the exposure together, you get your expected loss, or EL. And this isn't just some abstract theoretical number floating in the ether. This is the anticipated risk cost that a bank can actively plan for and bake right into their daily operations. Let's walk through a super simple math example just to see this in action. Imagine a fictional loan. Our exposure at default, the money completely on the line, is exactly $1 million. The probability of default is 0.5%, or 0.5%. And our loss given default is 60%, meaning, as we said, the bank expects a 40% recovery rate from collateral. So, you do the math, 1 million,
times 0.005 times 0.6, and you get $3,000. That is your expected loss dollar amount. It literally means, on average, the bank expects to lose $3,000 a year on loans with this exact risk profile. Having this highly specific dollar amount gives the bank the ability to price their loans accurately so they easily cover this average annual loss.
Moving to part 4, expected versus unexpected loss, preparing for the worst. So the crucial point here is understanding the difference between the everyday and the extreme. Expected loss, like we just calculated, is the average risk cost. It's just the normal cost of doing business. But unexpected loss, that is the extreme rare event. It's the sudden massive spike in defaults caused by things like economic crashes, pandemics, or financial contagion. It's the absolute worst-case scenario that your everyday averages just can't capture.
And there is a stark difference in how a bank actually defends against both of these. Expected loss is handled through standard accounting provisions. Think of it as the bank basically setting aside a little portion of its profits as a routine rainy day fund. But unexpected loss? That requires massive capital reserve buffers, like shareholder equity. This capital is the ultimate shock absorber. Regulators literally mandate it to prevent the entire bank from completely collapsing when a severe economic storm hits.
Finally, part 5, why do banks care? Let's look at the real-world impact.
Look, these calculations absolutely dictate almost everything a bank does. First off, it's about pricing loans fairly. If a borrower has a higher probability of default, the expected loss goes up, right? Which directly leads to higher interest rates for that borrower to cover the extra risk. It also dictates exactly how much money banks must set aside in accounting provisions, ensures they satisfy strict global capital rules known as Basel III, and helps them manage portfolio concentration risk, which is really just a fancy way of saying they know not to put all their eggs in one basket by lending all their money to just one volatile industry.
Now, what's really interesting about all this is this final, kind of provocative thought. Can an AI model completely replace human credit policy and underwriting judgment? I mean, while AI is undoubtedly incredible at crunching these PD, LGD, and EAD numbers and instantly speeding up signal detection, the consensus is that it can't replace us. Well, not just yet. Human judgment is still absolutely crucial to define what risks are actually acceptable, to set the policy guardrails, and to interpret all the nuanced context behind the data. The math gives us the forecast for sure, but humans still have to decide whether or not to step out into the rain. So what do you think? Would you trust an algorithm with the final say on your mortgage? Thanks for joining me for this explainer, and keep